Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today we're looking at ARM.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. ARM is such a unique company in the whole semiconductor space.
It really is. Its entire business model is just different.
Completely. And I think to understand it, you have to start with the financials. They really tell the story.
Let's do it. Looking at the recent performance, the demand just seems relentless.
It is. In the first quarter for fiscal 26, revenue hit, what, $910 million?
Yep, and that's an 18% jump from the year before.
Which, in this part of the industry, that kind of growth is a huge signal.
It absolutely is. But the growth is one thing. The efficiency of that growth is another.
You're talking about the gross margin.
I am.
Yeah.
It clocked in at 95% for the last quarter.
95%. I mean, just let that sink in. Most tech companies would be thrilled with 60. It's staggering. And it speaks directly to their business model, right?
Exactly. They have this incredible economic moat. They're not building billion-dollar factories. They design the IP, the blueprints, and then they license it out.
Kind of like a toll booth for the entire mobile industry.
That's a perfect way to put it. They're totally asset-light, so almost every dollar of revenue just flows straight through.
And that's what gets you to a 34% operating margin, too, which is also really strong.
Right, because their costs are so well controlled,
Right.
and that efficiency, it doesn't just stop at the income statement.
No, it lands right on the balance sheet, which
Yeah.
is, frankly, a fortress.
A fortress is the right word. As of this summer, they were holding about $8.7 billion in cash and equivalents.
And against that, what, just over $3 billion in total liabilities?
Just about $3.2 billion. And almost none of that is interest-bearing debt,
So they're sitting on a mountain of cash with practically zero leverage.
which means they can handle any downturn, buy a competitor, return cash to shareholders. Anything, really. It's the definition of financial strength. But that's just half the story.
The other half is how durable that advantage is.
I mean, their designs are in over 99% of the world's smartphones.
It's an unbelievable market position. You almost can't dislodge it because of the whole ecosystem built around it, the software, the tools, everything.
And they're not just staying in mobile, are they?
Not at all. That royalty model is moving aggressively into data centers, cloud computing, and especially automotive.
So this is where it gets really compelling for the future, I think.
Absolutely. Their fundamentals are perfectly lined up with all the big tech megatrends.
You mean things like AI, edge computing?
Exactly. AI moving to the edge, the Internet of Things, vehicle electrification, all of that stuff needs efficient, low-power processing.
Which is ARM's bread and butter.
It is. So they're not just riding one wave. They're at the center of 3 or 4 massive ones.
Yeah.
It creates this incredible visibility for growth into 2026 and beyond.
Okay, so that's the bull case. It's an incredibly compelling one.
It is. Which brings us to the, let's say, the big problem.
The valuation. The
Yeah.
elephant in the room.
A very, very big elephant. The market knows all this good news, and it has priced it for absolute perfection.
The numbers are pretty eye-watering. We're talking 74 times forward earnings.
And that's not even the big one. The enterprise value to EBITDA ratio, it's at 114.
114.
Yeah.
Just to give some context, the average for their peers is maybe around 18.
Right, so this valuation isn't just pricing in today's success, it's pricing in like a decade of flawless execution and explosive growth.
And that creates a huge risk, doesn't it? If they miss expectations even a little bit.
The stock could get crushed, not because the business is bad, but just because the multiple has to come back to earth. It's priced for perfection.
And with a valuation that high, every operational risk gets magnified.
Starting with the biggest one, China.
Right. Over a quarter of their revenue comes from there.
Which is a huge exposure. You've got the geopolitical risk, the export controls, all that uncertainty.
But there's another more strategic risk there too, isn't there?
Yes, and that's the rise of RASEV. It's a competing open source architecture.
And China is pushing it hard to become more self-reliant.
They are. So RASCV is a direct challenge to ARM's licensing growth in one of its most important markets. It's a real headwind.
And the risk isn't just about geography, it's also about customers.
That's the other concentration risk. A huge chunk of their revenue comes from just a few big names: Apple, Qualcomm.
So if one of them decides to shift strategy, it could have a massive impact.
A severe impact. And this leads to maybe the most interesting risk of all, This idea that ARM can start making its own CPUs.
That feels like a huge strategic pivot. They've always been the neutral partner, the Switzerland of semiconductors.
Exactly. But now they're talking about moving up the value chain. And if they do that, they go from being a partner to a competitor.
And you have to wonder how customers like Apple would react to that.
You do. You risk alienating your biggest supporters. They might start investing more in their own IP or, looking harder at alternatives like RISC-V.
It's a massive decision for them. The reward could be big, but the risk of blowing up their core business is also very real.
So with all this in mind, great fundamentals, huge risks. How are analysts looking at it?
Well, the sentiment is still mostly positive, but you can definitely see the caution creeping in.
The average price target is still pretty high, right? Around $163.
Yeah, $163.62, which suggests, maybe 19 to 23% upside from here.
But we have seen some downward revisions lately.
They have.
Yeah.
And they seem to be focused on exactly what we just talked about.
Near-term margin questions and the whole China situation.
Yep. The long-term story is intact, but the caution flag is definitely up for the near term.
Okay, so with all that volatility priced in, let's look at the charts. Where is the stock actually trading right now?
Technically, it's in a consolidation phase. It's trading around $136.99, up about 15% for the year.
And we're looking at a pretty wide trading range for the next few months.
A very wide range. We're projecting something between, say, $120 on the low end and $170 on the high end.
So for anyone trading this, what are the key levels to watch?
Well, there seems to be some solid support forming down around that $128 to $130 area.
And on the flip side, the resistance looks pretty strong near $165 to $170.
It is. A clean break above $170 would be a really bullish signal. It would suggest the momentum is shifting back to the upside in a big way.
And what about the momentum indicators themselves?
They show that things have cooled off. The stock is sitting just below its 50-day moving average, which is around $146.
But the oscillators are telling a more interesting story, aren't they?
They are. The RSI, the Relative Strength Index, is low down around 32, and the stochastic RSI is even lower, below 10.
And for anyone listening, what does that actually mean?
It's basically a technical signal that the stock is getting into oversold territory.
Meaning the recent selling pressure might have been a bit overdone and it could be due for a bounce.
Exactly. So while the fundamentals scream valuation risk, the technicals are hinting at a potential short-term pop if we get a positive catalyst.
Which is the perfect transition. What are the catalysts we should be looking for?
Okay, so on the scheduled side, we have a few big ones. The annual general meeting was on September 9th, and that's where we should get more clarity on that whole in-house CPU strategy.
Right. And then, of course, the big one, earnings.
The Q3 release in November, that's what everyone will be watching. Continued growth, and especially if that 95% gross margin holds up.
And there's also a potential structural catalyst in December, right?
Yes, the ETF rebalancing. If ARM gets added to or has its weight increased in major indices, you'll see a lot of force buying from passive funds.
Okay, so that's the stuff we know is coming. What about the rumors, the speculative stuff?
The biggest piece of market chatter is about a new strategic partnership with a major AI hardware company.
That would be huge. It would instantly validate the next chapter of their growth story.
It would. And given their cash pile, there's also a lot of talk about a big share buyback program.
Which is always a good way for management to signal confidence and boost the EPS.
Exactly. And then there are whispers about a bigger push into automotive semiconductors and maybe even acquiring a smaller rival IP firm.
And we should keep an eye on the big tech conferences coming up through January. That's usually where these kinds of announcements get made.
For sure. So you've got this mix of scheduled events and high-impact rumors that makes for a very interesting setup over the next quarter.
Okay, so let's tie it all together. What's the investment horizon here?
Well, even with the huge valuation concerns, the bull case is still incredibly strong.
You've got the world-class recurring royalties, the strong growth, the expansion into AI and IoT, and that fortress balance sheet.
So who is this stock actually for right now?
I think it's for two different types of people. First, short-term traders who are playing those catalysts we just mentioned, earnings, partnerships, ETF inclusion.
And the second group.
Long-term investors. If you want sustained exposure to the biggest secular trends in tech AI, edge computing, autonomous vehicles, you almost have to have some exposure to ARM. They're an indispensable player.
Here's a final thought for you to chew on. ARM's unique IP platform makes it an irreplaceable player in the future of computing and technology. But when you are paying a massive premium for that access, a valuation that prices in nearly a decade of success, investors must be hyper-aware of the high valuation and rigorously monitor execution, particularly their success in navigating the political and competitive challenges in China and the potentially strained customer relations resulting from their internal CPU expansion efforts. Execution is everything when you are trading at 114 times cash flow.